Hi folks. Today I'm joined by Terry Smith from Fundsmith. Fundsmith are an asset management business that run one type of portfolio which invests in global equities. So Terry, if I could just kick off by asking you maybe to characterise the types of businesses that you're attracted to and that populate your portfolio.
Yeah, we invest in a relatively small number of companies compared to most people. They're big international businesses. I can give you a list of financial characteristics. For example, they make high returns on capital in cash, so their cash generation divided by their capital employed is a high number right across the business cycle, so they even do okay at the bottom of the economic and business cycle. They have very good margins, including their gross margins between revenues and cost of sales, not just their operating margins. They don't rely on leverage, so they don't have a very small unlevered return and lever it up. So there's a lot of things like that we look for. But there's one big characteristic that if people say to me, well, look, just give me one characteristic that defines these companies that you invested. They make their money out of a large number of everyday repeat, relatively predictable events. When we consume our everyday necessities and luxuries, our snacks and our drinks and our cosmetics and our toiletries and our household cleaning products, or they supply installed bases of equipment or software that's used daily to process things like payroll processing companies or elevator and escalator maintenance companies, or they're franchisors who use other people's capital. So their financial characteristics are driven by the fact that the franchisees put up the capital, sometimes fast food, sometimes in the hotel business. But the thing to hold in mind mostly is that characteristic of a large number of everyday repeat transactions that really drive them. They're very well established companies as well. Companies of this sort, companies that have got big brands or installed bases of equipment or franchise operations, kind of don't sneak up on you all of a sudden. They're not startups and so on. I mean, on average, they've been in existence for over 100 years.
So, and with that sort of characteristic, they'd be quite, or they'd be much less economically sensitive, which would be a great characteristic to have in the current economic climate. Now, one thing that a number of people will notice about the type of stocks that are in the portfolio is, on the surface of it, they look fairly expensive relative to the broader stock market. So in terms of the multiple of their profits, typically 17 to 18 times would not be unusual for these sort of stocks. Could you maybe address why that's not a big concern for you?
Yeah, I mean, I wouldn't say it's no concern at all. They definitely have become more expensive in the last couple of years. More people have been attracted to those stocks by their defensive characteristic. But it doesn't stop me investing at the moment. I don't think it's reached a pitch where it's something that is an overwhelming worry. Why do I say that? I mean, obviously you've expressed it in terms of PE relative to the market, which is the way people would normally express it. Fun enough, when I'm working on the portfolio, I don't use PEs. And the reason I don't use PEs, and it does come back, I think, to address this point, is because, as I put it, not all E's are created equal. So our portfolio may be a bit more expensive than the market. It's a couple of points higher in terms of PE than the market. But its E's, its earnings, are generated with much lower capital intensity. In other words, they have a much higher return on capital, and they convert much more of those E's into cash than the average company. So if you look, our average company makes something over 30% in terms of return on capital employed, whereas the market is probably around a third of that, in fact. So they're actually far better quality than the market as a whole in terms of return on capital, in terms of cash generation, and in terms of predictability. That's why I think it's okay.
Great, okay. And sticking with the portfolio, would you be able to maybe pull out one particular stock that you think looks particularly attractive in the current environment?
Yeah, I mean, the stock I'm buying most at the moment is Visa. What is Visa? It's the biggest payment processing company in the world. Most of us all know it because we've got a Visa debit card or credit card, or maybe both in our wallet or our purse. So it's basically in a duopoly with MasterCard. Those are the two biggest payment processors in the world. It doesn't take any credit risk, which is important. It processes the payments, which we make with our credit cards and our debit cards, but the credit risk is taken by the issuing bank, by our bank that has our account, which issues the credit card. That's quite important. So it's not that economically sensitive. It's got a great growth story behind it. Basically, if you look at the company and what it does, you can see that it's gradually encroaching on the cash transactions in the economy, and that's being replaced by the use of various means of payment that they process. Originally credit cards, but now debit cards, and no doubt in due course so-called digital wallets, where you'll use a mobile device to make the payment. It fits one of our essential characteristics, which I've said is about only investing in companies that make their money from a large number of individual transactions daily. The last time I looked, Visa does something like 50 trillion transactions a year with a value of like £5 trillion. It really does a vast number of individual transactions. Its financial characteristics are wonderful. It's got 60% operating margins, which is just fabulous, and it's got about a 20% return on invested capital. You might say with all of this, well, what's the issue? And there could be a couple. The most obvious one is valuation. At the moment, you can buy it on about a 5% free cash flow yield, which is not sort of blow your socks off cheap, but combined with the fact that it's growing at about 10 to 15% per annum because of the eradication of cash transactions in the economy as it grows into that, a 5% free cash flow yield with 10 to 15% growth would tend to suggest that you should see the shares appreciate if they just remain at a fairly constant valuation and deliver that kind of growth. They should sort of grow at 15+% per annum, which is certainly adequate for us to own. And of course, they may do better than that. It's possible. The other possible downside other than valuation, which people might dream up, is the sort of litigation regulation angle. They are under pressure.
Which has been a recent concern.
Yeah, there's been a recent concern about. There's been a recent court case in America about whether a settlement with the merchants who use the cards is valid. And I think that's a constant that you have to live with. One of the problems I find in managing money now is it's almost impossible in the macroeconomic environment we occupy to find a company that's a really good company and is cheap and has got no issue. The only reason it ever gets to be viable is because it's got an issue. I don't think that the regulatory litigation environment is that damaging to these companies. They have huge cash reserves which they put by to handle those situations. And the fact of the matter is, I don't think there's any means of breaking their duopoly.
Great, thanks. And if I could finish with a subject that's close to my heart, which is alignment of interest from fund managers. Yeah. Maybe you could just talk about the extent to which you're personally invested in your own fund.
Yeah, I've got about £42 million invested in my fund at today's valuation, which is a pretty significant portion of my net worth. I've got some assets outside of that. I still run a public company and I have a big shareholding in that. And obviously I've got some properties that I live in and so on. But it's the only vehicle that I now use for investment. So it's, I guess, not only is it significant, but it will be an increasing portion of my net worth over time, assuming it does okay, because that's where I direct the remainder of my investment at the moment. And I think that's important. I'm personally of the belief that no other kind of structure truly aligns people's interests. People always say, well, performance fees align interests. Well, I always make the same offer to people who say that, which is, well, if you think that, if you give me some cash, I'll go to the casino on the way home and play a bit of blackjack, and if I win, then I'll give you 80% of the winnings. We're aligned. Right? No, we're not, because I'm playing with your money, basically. And so I'm a great believer that to really be truly aligned, it's important that you both eat the same cooking.
Yeah, great. Well, that's very reassuring. So thank you very much for listening in. For those of you who are already invested in the Fundsmith Equity Fund, hopefully that's a very useful insight into the thinking behind it. And for those who would like some information on the fund, please contact your broker for a copy of our note. Thanks.